Welcome to Alpha Recap, your quick hit on what mattered in the markets today. We're wrapping up Friday's action after the close, and yes, markets close for the long weekend, so we're talking about what already happened, not what's happening. As always, if you have questions, you can reach us at stockalpha.ai.
Hey everyone, big session to recap. Concentrated volatility, some dramatic moves in leveraged products, and a handful of microcaps that lit up without much of an explanation. Plenty to unpack before markets reopen.
Let's start with the headline. Amazon had the session's biggest and most consequential move among the large cap names. The stock finished down about 5.5% to roughly $210.32 on about 179 million shares traded. That's a hefty print for such a liquid name.
Right. And that's important because when a mega cap like that drops with heavy volume, it doesn't just matter to people who own Amazon. It ripples through index funds, through ETFs, and it forces hedging flows from institutions. Into a long weekend, that created elevated gap risk.
Gap risk is the key operational takeaway. If you close the bell on Friday and something happens over the weekend, a regulatory headline or a surprise macro print, you could open Monday with a much different price. That's why Big Friday moves in names with lots of options and ETF exposure are a red flag operationally.
Speaking of ETFs, the leveraged and inverse space was loud. The triple leverage growth product was up about 6% to roughly $50.60 on around 117 million shares. At the same time, an inverse semiconductor levered product was down about 16% on about 573 million shares. And another niche levered product collapsed down about 58% to around 27 cents on about 31 million shares.
Those are the kind of prints that make you sit up. Leveraged ETFs are like magnifying glasses that they make small moves look huge in a hurry, but they also have their own dynamics that can diverge from the underlying sector, especially when flows concentrate.
Exactly. We also saw wild strength in a bunch of small and microcap names with no headline to justify it. One stock ran up about 90% to roughly $15.83 on about 39 million shares. Another was up about 67% to about $2 on roughly 103,000 shares. There was even one that jumped about 90% to a penny on only around 22,000 shares.
Those feel like classic momentum or retail squeezes. Little liquidity, big percentage moves, and no press release. Traders smelled an opportunity and piled in. The tricky part is sustainability. Without filings or real fundamental news, these moves can reverse just as fast.
That brings us to the big themes we saw. Concentration of volatility, the momentum versus fundamentals debate, and how leveraged products can amplify the market narrative. Want to break each one down?
Let's do it. First, volatility concentration and liquidity rotation. Friday concentrated action in both a mega cap and in leveraged wrappers. That combination can create outsized intraday and multi-session swings because you get underlying moves, index rebalances, and then the levered instruments reacting on top of that.
A simple way to think about it, if Amazon drops, index ETFs that track the S&P or other benchmarks have to reflect that. And people who sold options against Amazon might have hedged by trading the stock. All of those flows layered on the same day can make moves much larger than they would be in isolation.
Second theme is momentum versus fundamentals. For megacaps, heavy volume often means institutional repositioning. There's usually a reason you can find. But for the microcaps, heavy volume with no news is ambiguous. Some analysts said the volume could indicate sustained interest. Others said it was a classic squeeze that would likely mean revert.
For everyday investors, the takeaway is simple. If you're a trader, these setups can be catalytic. But use tight risk management. If you're a buy and hold investor, don't confuse a headline percentage move in a microcap for a durable change in value.
Third, leveraged products amplified the story. When the growth-levered ETF rallied, that suggested short-term tech buying. When inverse or niche leveraged products plunged, that showed just how ugly re-leveraging can get. These instruments are fine for tactical exposure if you're active, but they can blow up a passive portfolio if you treat them like regular ETFs.
A plain example, the leverage product that fell almost 60% to 27 cents. That kind of move is either a structural event or a violent repricing. Either way, it's a red flag to check filings and corporate disclosures as soon as markets reopened.
Let's talk about the debates that cropped up in coverage. First, how to read volume. Some argued heavy volume confirms continuation. Others said it could be capitulation or a squeeze climax. Context matters. Big blue chip volume often reflects institutional flows, whereas microcap spikes are more likely speculative.
Second debate was pre-earnings positioning in Salesforce, which is scheduled to report fourth quarter results on February 25th. Do you position ahead to capture a potential upside, or do you avoid the headline risk and trade around the event? Options traders might buy volatility or construct spreads. Long-only investors might trim ahead of the print.
And third, how to treat leveraged ETFs. Some saw the growth-levered ETFs gain as bullish for tech exposure. Others used the big losses in inverse products as a warning about vulnerability and re-leveraging risk. The practical rule here is leveraged ETFs are tactical, not strategic, unless you're actively managing them.
Now, for the biggest single items, Amazon's down move was non-trivial. When a mega cap with huge options activity moves like that, it can trigger stop-loss cascades and force portfolio reviews. Active managers were probably assessing position sizing and hedges over the weekend.
And the leveraged names, the growth-levered fund was up around 6%. The inverse semiconductor levered one was down around 16%, and the other levered products near collapse deserves a close look. Those moves can change a portfolio's daily volatility dramatically.
For the microcaps, traders should have been watching for follow-up filings or press releases. Volume confirmation on the next session would help validate those moves. Absent that, they're just very risky bets.
All right, practical advice for different types of investors. Long-term holders, don't overreact to a single session, especially in small caps and levered ETFs. For big names like Amazon, use this as a chance to reassess your thesis and consider layering exposure, rather than averaging all at once.
Active traders and momentum players. The tape offered opportunity, but you needed strict risk controls. Tight stops, demand follow-through volume, and be very mindful of overnight gap risk heading into a long weekend.
Options traders, events like the Salesforce fourth quarter report on February 25th and elevated volatility in certain names were actionable. But buying premium into earnings or into a hot microcap can be expensive. Consider spreads or defined risk structures.
Institutional managers and risk teams, heavy volume in Amazon and big flows in leveraged products should have prompted stress tests, margin buffer checks, and counterparty reviews over the weekend. That's the kind of housekeeping that pays off when markets reopen.
Short sellers, microcaps with sudden upside volume are squeeze magnets. Inverse and leveraged ETFs can be particularly unforgiving. If you shorted into these prints, options or strict position limits would have been your friend.
As for strategy heading into next week, keep 5 things in mind. Treat the long weekend as elevated risk, demand confirmation for momentum trades, use leverage sparingly, prepare for Salesforce's earnings on February 25th if you have exposure, and watch filings for smaller names that move dramatically.
To sum up, Friday's tape was all about concentrated volatility, a meaningful decline in a market-moving megacap, headline-making leveraged ETF moves, and speculative microcap breakouts. That mix raised short-term uncertainty and made disciplined position management the order of the day.
Clear takeaways. Don't treat levered products like regular ETFs. Don't confuse microcap momentum with lasting fundamentals. And if you're exposed to names with big options interest, check your hedges heading into a long weekend.
That's our recap. If you want more detail on any of the moves we talked through today, head over to stockalpha.ai.
And if you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Have a great weekend. We'll be back after the market reopens.